You have a choice. Let inflation run wild but save the economic system, or fight inflation but risk blowing up millions of dollars of citizen savings. This is a choice that Jerome Powell, head of the Federal Reserve or Fed, has to make. Last week we saw a series of banks failing, partly because the interest rate set by the Federal Reserve is the highest it has been in 15 years. Jerome makes an interest rate decision every 6 weeks. The one on the 22nd of March is even more important because it has potentially disastrous consequences. Hi, I'm Tim, trader at the Camp Compound, and today we are discussing the two possible consequences of tomorrow's decision by Jerome Powell. Let us explore what might happen if he does or doesn't raise rates. Situation 1. No raise. The interest rates are the number one weapon against inflation. The Federal Reserve was made to keep inflation at 2% and unemployment at 4%. Just before the banks started going through their knees, Powell promised that the interest rates would be higher for longer than the markets expected. If Powell pivots on this statement at the first chance he gets, it will seriously hurt his credibility. It would also signal that Powell has indeed lost control over both inflation and economy, though we could of course question how much control he really had to begin with. The likely result is that markets boom up as a scramble for anything scarce begins. Most people are unaware of what this implies: a broader financial crisis rearing its head and a following deeper slide in the markets. In this case, the smart trader will firstly take careful positions to ride the way up, keep an ear to the ground for the realization and decline of the market, and then short the way down. Situation 2. A raise. Jerome and his friends raised the interest rate by another set, mainly to show that they are still in control. This will further create trouble for the regional banking players and potentially cost customers their savings. This incentivizes the customers to take their deposits to bigger banks who are protected by the US government. Because of this protection, these banks take higher risks and have a so-called moral hazard. The likely result is that the markets halt their current advance upwards as deposits and risk are consolidated into these morally bankrupt institutions. As smaller banks continue to fall, a smart trader will short regional banks, keep an ear to the ground for bank alternative narratives, and move away from banks where possible. So in conclusion, we have to keep our eyes open as the economy takes a dangerous turn. If you want to learn how to navigate these waters with trades and updates, then join our community with the link in the description and subscribe to the channel. In the meantime, make sure to keep calm, keep cool, and keep compounding. Bye bye!